It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. We're taking a look at two stocks with exposure to interest rates. They've been on a bit of a ride over the past year, so what's the best way to play it now? I'm here with Adam Johnson, Bullseye American Ingenuity Fund Portfolio Manager. It is great to see you.
Great to see you, Jules.
So let's get to the stock that you're recommending folks buy. It is Builders First Source.
Yeah,
so this is a provider of stuff that goes into homes here. And indeed, you can see the kind of wild ride that the stock has been on over the past year. So let's get to why you like it. There is indeed a shortage of housing. There is
a housing shortage, and it's a big one. By some estimates, as many as 5 or 6 million units. And that is a number that has been confirmed probably by 3 or 4 other independent operators. That number is from Freddie Mac, the 5 or 6 million. And it's because you know, back in 2008, they were building too many houses, and we're still sort of suffering from that muscle memory. So housing shortage creates the argument that you're going to have prices moving up. And if you're talking about a company that supplies to builders, you know, that's good for them. You need to build more houses. That's point number one. Point number two, bring that up, mortgage rates are likely to come down. So if you've got inherent demand because there aren't enough houses out there, and you have mortgage rates coming down so you can actually start to afford houses, again, it reinforces the argument that you want to be long building type companies. You want to be in the housing sector. You want to have exposure to the housing sector. And then point number three, the stock is cheap. It's really simple. Trading at about 10 or 11 times earnings. Now, the earnings are down this year because we're just not seeing the housing demand that we've seen in the past. But I think that's starting to turn. And if you listen to what management is saying, they're actually guiding for 15 to 20% growth next year because they're already seeing forward orders for next year in anticipation of what we're talking about. The housing shortage, building more houses, and rates coming down, creating demand. Right, and it's been an interesting picture among the builders themselves, right? Because mortgage rates have been high, they've had to offer incentives to get the houses, but they're still building the houses. They're still buying stuff to go from places like builders to put into the house. Well, and as a matter of fact, if you listen to what management at Toll Brothers said on their recent call, they are selling out faster than expected, and they're starting to build more spec houses just to meet demand, which is fascinating because, you know, for the past couple of quarters, there hasn't been the demand, but people are already starting to come in and buy. So we always talk about what the potential risk is. In this case, it's that, well, you don't have either the economy stagnates and buyers don't materialize, or it just gets pushed out further, I suppose. Yeah, that's right. You know, there's this notion that, well, wait a minute, maybe we're going to go into recession. I don't think we are, and we saw that strong GDP report this morning, 2.8% growth. So I don't think that that's an issue, but it's always out there. You know, or if inflation were to reaccelerate and the Fed had to actually go the other way and raise rates again, that would certainly be a negative. But again, I don't see that as an issue. I really don't. Yeah, that seems like a pretty out there. I think so. So I'm very comfortable owning this stock, and especially given the valuation, 10, 11, 12 times earnings. And you do own the stock. Oh yeah, I own it, so do my clients. Gotcha. All right, let's get to the stock you say folks should avoid. That is Charles Schwab. Charles Schwab, too, has been all over the map. I mean, I think this drop here was the one after its latest earnings report, which was disappointing. You say it's dead money. Now, for people who don't know what that means, explain what that means. So dead money means you're not making any money. It's just sideways. And while if you look at that chart, it appears like it's up and down. The fact is the all-time highs were 2.5 years ago. So in other words, for 2.5 years, the stock has been, in fact, dead money. You have not gotten back to the old highs. The rest of the market is making new highs, but Charles Schwab is not. So dead money, you gotta, you know, you want to put money to work, and this doesn't seem to be working. Well, and it's interesting because Charles Schwab got kind of caught up in the regional banking crisis, but even if you could look back further and you look at the earnings, it's the past 6 quarters that we've, before that happened, that earnings have been declining. So truth be told, in full disclosure, I was along this, both for myself and for clients. And it's because earnings just can't seem to get jump-started. I mean, earnings declines for 6 quarters in a row. You know, they bought TD Ameritrade. I thought, oh, I'm going to buy this because they're buying TD Ameritrade, bringing whole new customers. That's accretive to earnings. Nope, hasn't materialized yet. And so I actually sold it for these reasons. Dead money, consecutive earnings declines, and Point number 3, I keep waiting for the turn, but it hasn't happened. $6.1 trillion of capital is sitting on the sidelines, not being put to work by Charles Schwab clients, but instead in government bonds. It's just parked on the side. I keep waiting for that money to come in, right, and propel the market higher. And that may happen, but again, how long do you want to wait for that to happen at Charles Schwab? I don't. I just think it's dead money.
You're done waiting.
I'm done waiting.
Okay, so
I'm over it.
You know, we talked about what could go wrong with Builders First Source. Let's talk about what could go right for Schwab.
Sure.
Maybe that $6 trillion on the sidelines finally says, okay, I'm not as tempted by my 5.5% I'm getting on my CD or whatever it is.
Right.
I'm going to put it back into stocks, and I'm going to put it with Schwab in particular.
Yeah, exactly right. And I call this a market rally that basically rises, brings all the boats with it, right? Rising tide lifts all boats. The theory being, yes, that money comes back in. It not only finds its way into Schwab brokerage accounts, but people just look at Schwab and say, hang on, it's been down for so long, it's got to go up at some point. And if the market's going up, Schwab would be a logical beneficiary of that. So I think that's your risk, but that's kind of nebulous, and it's a bit of a reach. And if they haven't been able to get there yet, again, that's why I sold the stock. I got tired of waiting, Julie. You know, there are other things to buy.
Yeah, exactly. It's a whole big market out there, as we like to say.
That's right.
All right. Thank you so much for being here, Adam. I appreciate it. So Builders First Source, buy that one. Avoid Charles Schwab. Thanks for coming in. Appreciate it. And thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.